Welcome back to Midday. We start the show off with all our financial news today, or tips, I guess you could say, with Julia Clapp from Abbott Wealth Management. Thanks for being here, Julia.
Thanks for having me, Tanya.
So I know that the topic that you wanted to touch on today is really about what's coming up next in the market. So the financial crisis of 2008, you were mentioning earlier that people sort of see this as an anniversary of that, as a big anniversary of that.
Yeah.
And we know that that was considered by many economists to be sort of the worst financial...
since the Second World War, actually,
So quite significant. So are people, what's the feel among many people right now? Are they a little worried about what's coming up next?
It's a little bit. So just because right now we're in the one of the longest bull runs in history, so that's that upward market. So eventually at some point it has to end.
Right.
So because it's been 10 years since the financial crisis, that was the most recent lowest point in the market.
Right.
And since then we've been recovering, but it will end at some point.
Yeah.
So once things start to change in the market, there's lots of different indicators that specialists look at, but we're not quite there yet. But just the fact that we know that we're in the longest bull market is something to kind of be cautious about.
Yeah, don't get too comfortable, I guess you could say, right?
Yeah, exactly.
Yeah, so I know we have a few slides that maybe we can start by throwing up the first one here. So what's next in the market? And you can take us through these slides if you want, Julia. So not if, but when.
Yeah, so like I was saying, it's just kind of about that matter of time. The market is cyclical, so we've got the contractions and then the expansion. So we're still expanding, but it's slowing down for sure. It is anticipated to be less severe than 2008.
I was just going to say, could it be that bad? Was that rock bottom?
So most likely, yes. Again, it's that we're not fortune tellers. We don't have a crystal ball telling us what's next, but it's very unlikely that it will be as bad as 2008. So that was an anomaly of lots of different things kind of hitting their breaking point all at once. Okay. And then that kind of resounding amongst the world.
Exactly. Yeah. And then I guess you should probably measure your level of risk in because everybody's portfolio is different. Yeah. So maybe you can tell us a little bit about how to do that.
Definitely. So I find a lot of people don't really know what they're invested into. So they're looking at the Canadian stock market, the TSX index, and seeing the gains and drops in the value of the index, and that's really concerning to them. So a lot of times there's people are invested into like a pension plan or a group RSP plan, most commonly. Lots of people invest on their own too, but with those investments, you can select different funds. And if it's a company plan, essentially you have a list of funds that you can choose from. You go through a little questionnaire that assesses what your risk tolerance is. So that kind of helps to determine what to invest you into. And some people are actively involved in that, others are not. Okay. Most likely, if you're not actively involved in the selection, either you're in something that's not invested into the market, or you're in something that's like a target date fund. So you say, I want to retire in 2030. Right. And as that date gets closer, you move from those three main asset classes. So the most risky is stocks, companies, equities, and bonds, which kind of smooth out the ride. There's less volatility within your portfolio, so less ups and downs if you have a stronger component of bonds. Okay. There's also a smaller chance of growth with a stronger bond portfolio. But as you get closer to retirement, you want more bonds in there just to kind of smooth things out.
Okay. I know we only have running out of time, so we only have about a minute left or so. So the next one that you have on there is, and I'm not sure if we still have it on, if we can put it back on screen. There we go.
So how do you come out on top? There's definitely other asset classes within the cash bonds and stocks. Different alternatives include things like real estate, infrastructure, private equities. So once you get to that, you've amassed that amount of wealth, you need to kind of protect that. Okay. And alternatives are another way to protect it, and making sure that you're looking at your individual situation with your advisor, your team of advisors, is super important, because there is opportunity cost to going into more conservative investments when you don't necessarily need that. So for someone who's young and has a lot of time, it's an opportunity cost that to be investing more conservatively.
Okay, so be prepared is what this all boils down to,
yes,
right?
and definitely make sure that you're talking with your advisor and making sure you're well-rounded for your long and short-term needs and goals.
And pay attention to, I mean, you may not think that a recession could impact you, but it could, right?
It could,
and it doesn't matter
Yeah.
how old you are or anything like that.
Yes,
Okay, we'll feel
definitely.
the effects of that for sure. Thanks, Julia. Appreciate
Thank
that.
you,
AbbottWealth.com is info@AbbottWealth.com is where you can find out some more information and get a hold of them. We'll be right back. Stay with us.